Hello guys, marginal costing. So what is the marginal cost? In economics, marginal cost means it is the incremental cost of production. So first, this is a marginal cost. Then we'll see marginal costing. The incremental cost of production. Whenever the incremental used, there is some type of comparison. So incremental of what? The incremental cost of production which arises due to 1 unit increase in the production quantity. Which arises due to 1 unit increase in the production quantity. Let's see example so you can understand better. For example, the cost of producing 10 units is like 10,000. Let's say cost of producing 10 units. This is your capacity, normal capacity. If you are able to produce 11 units, that is a increase in 1 unit. 1 unit means 10 plus 1. So cost of producing 11 units is a, let's say, 10,500. So what is the marginal cost? Marginal cost is a 10,500 minus 10,000 rupees 500 is a marginal cost. So what is the marginal cost? Marginal cost, as understood in the economics, is the incremental cost of production which arises due to 1 unit increase in the production of quantity. So 500 is the marginal cost. You may have doubt, for 10 units 10,000 cost of production, rupees 10,000, 11 units 10,500. Why only 500 increased? It should have been 11,000. But in marginal cost, we consider only variable cost. Only variable cost. That means fixed cost is not attributable. So variable cost is considered, fixed cost is not considered. Why? What is the reason? Reason being, if the quantity varies or increases or decreases, variable cost also increases or decreases. But irrespective of quantity change in production quantity or a decrease in the production quantity, fixed cost will remain constant or same. That is why marginal cost says these costs are irrelevant. For what? For additional n plus unit production. It is relevant for the n units, for the 10 units, but plus 1 it is irrelevant. This is relevant for all the production. Why it is what is the logic behind? Logic is, if you produce this product, this will incur whatever happens, it will be incurred. If you produce 10 units, the amount is same. If you produce 11 units, amount is same. So we are better to consider this is a relevant one. This is not relevant for the 11th unit. Similarly 12th unit, because up to 10 it is a fixed cost, is fixed, irrelevant of your quantity increase or decrease. Okay, let me give you one more example so you can understand better. Marginal cost. Let's say Zuhana Limited is producing 10,000 units. Units of any product. You say product A. This is illustration. 10,000 units are produced. The total cost is 3,50,000. This is in numbers because it is a units. This is in rupees because it is a cost. Rupees 3,50,000. See, these are the breakups. Breakup of costs. DM. What is DM? Direct material at rupees 10 per unit. So 10,000 into 10 per unit, it comes up to 1 lakh rupees. These are the information. We'll explain marginal cost. Now I am explaining the breakup of 3,50,000. Direct labor or employee cost, labor cost. So direct employee cost or labor cost is 8 rupees 8 per unit. 8 per unit. So 10,000 units into 8 per unit, it comes up to 80,000. Third breakup, variable overhead, OH overhead at rupees 2 per unit. At 2 rupees per unit, so that comes up to 20,000 rupees. Fourth one, fixed cost. fixed overhead rupees 1,50,000. That is up to yeah, 10,000 units, no, maximum up to, let me give 50,000 units. If you produce 50,000 units, your fixed cost will be remain same, that is 1,50,000. If you produce 20,000, your fixed overhead will be 1,50,000. If you produce 30,000 units, your fixed cost variable will be, fixed cost overhead will be 1,50,000. But this will change. Direct material, direct labor, variable overhead will change according to the number of quantity produced. Okay, Zuhana Limited is producing 10,000 units. So for marginal cost, Zuhana Limited wants to know what is the marginal cost of 10,000 first product. For this product, that one product after 10,000, what is the marginal cost? We'll find out. Let's say this is our 10,000 units calculation. 10,001 units, change in cost. If I say A, this B, change in cost will be B minus C, sorry, B minus A, this minus, let's say this is C. First one, we know direct material 1 lakh rupees. Here it will change, rupees 10 into 10,001, so it will be 1 lakh 10 rupees. How? 10 rupees per unit into number of units produced 10,001, you will get 1 lakh 10 rupees. Number 2, direct labor cost. This is a 10 per unit, this is rupees 8 per unit, so it will be 80,000 here, 80,000 8 rupees. Then comes a variable overhead, that is rupees 2 per unit, 20,000 for 10,001 unit into 2 rupees, 20,000 2 rupees. What is the change here? Here change is 10 rupees, 8 rupees, 2 rupees. This is very important. Fixed overhead. What is a fixed overhead? 1,50,000. Here also 1,50,000, same, it won't change even if it is a change in the quantity of the production. So there is a no change, 0. So total will be total 3,50,000. Here 3,50,000 20 rupees, 10, 8 to 20. So answer is extra cost will be marginal cost would be 20 rupees. So extra cost would be rupees 20. So this is all about the margin. So what is the marginal costing? We seen marginal cost. What is the marginal costing? It is a costing system. Same, whatever we apply there, that is a system. If we make it a system costing system, it is known as a marginal costing. It is a costing system. Where products or services and inventories, that is stocks, are valued at variable costs only. Fixed cost is ignored. Correct? So it does not take consideration of fixed cost. So this is the introduction to marginal costing.